The stock market faced a sharp sell-off today, despite optimism surrounding the Trump-Xi meeting. Both leaders described the summit as productive, and even Trump rated it a 12 out of 10. Yet, markets reacted negatively. The one-year trade truce offered temporary relief, but investors sensed deeper unresolved tensions between the U.S. and China. While some tariffs were eased, including those on fentanyl, and China announced soybean purchases, traders viewed the deal as buy the rumor, sell the news. After weeks of optimism lifting the S&P 500, reality set in, and prices pulled back sharply. The enthusiasm faded as investors realized the agreement lacked long-term clarity. The market's reaction signaled uncertainty about global trade stability, especially given lingering differences between the two nations. Despite the upbeat headlines, Wall Street viewed the truce as fragile, more symbolic than substantial, sparking widespread caution among traders and analysts alike. Adding fuel to the market's weakness, Meta experienced a staggering $228 billion drop in market capitalization, the eighth largest single-day loss in history. Despite strong earnings, revenue, and EPS beats, investors were alarmed by Meta's surging capital expenditures. CEO Mark Zuckerberg defended the company's aggressive AI investments, calling them essential for long-term growth. However, the short-term market reaction was brutal. Meta shares fell over 11%, dragging down major indices due to its heavy market weighting. This decline followed the S&P 500's weakest breadth day ever, an up day where only 104 stocks rose while 398 declined. With tech giants like Nvidia, Apple, Microsoft, and Amazon propping up the market, any weakness in this Magnificent Seven group now has outsized influence. Meta's fall reminded traders that concentrated strength can quickly turn into collective vulnerability when sentiment shifts or valuations appear stretched. A technical warning rattled Wall Street as the infamous Hindenburg omen triggered once again. Historically, after this signal appeared, the S&P 500 fell 83% of the time within 2 months. The omen reflects unusual market behavior, when both new highs and new lows occur simultaneously, signaling internal instability. Analysts cautioned that while it doesn't guarantee a crash, it often precedes periods of heightened volatility and corrections. Combined with stretched valuations and heavy dependence on a few tech giants, traders are now watching closely for follow-through selling. Many see this as evidence that the market's uptrend is losing steam. Key support zones around SPY 682 and 678.50 have become crucial to monitor. A breakdown below those levels could confirm weakness and trigger broader risk-off sentiment. With uncertainty rising, even minor disappointments could accelerate selling pressure across sectors in the coming weeks. As market volatility climbs, traders are shifting strategies. The volatility ETF UVXY gained attention as investors hedge against potential sell-offs. During past downturns, UVXY surged dramatically, making it a key watch for risk management. Meanwhile, speculative setups in names like Moderna, mRNA, and SoFi revealed contrasting momentum, with mRNA surging on acquisition rumors while SoFi slipped toward critical support levels. Analysts also noted unusual options activity in IEF, reflecting bets on a bond market pullback following Powell's recent remarks about internal Fed divisions and uncertain rate cuts. Overall, traders see a market at crossroads. Optimism from selective tech wins versus warning signals from historical indicators. With a Hindenburg omen active, key supports being tested, and volatility picking up, the next few sessions could define whether this pullback becomes a buying opportunity or the start of a deeper correction.